Welcome back to Talkpoint. We have got some good news for your wallet. US inflation is showing signs of cooling. According to fresh data from the Labor Department, July's inflation rate cut in at just 2.6% down from 2.9% in June. That's the lowest level in over 2 years and a big step closer to the Federal Reserve's target of 2%. But what does this really mean for the economy, for interest rates, and for your everyday life? Let's break it down. The Consumer Price Index, or CPI, which tracks the cost of everything from groceries to gas, rose 2.6% in July compared to a year earlier. That's a significant slowdown from the peaks of 2022 when inflation hit over 9%, the highest in 4 decades. On a month-to-month basis, prices increased just 0.2%, signaling that inflationary pressures are easing across most major sectors. CPI graph from 2021 to 2025 highlighting July's drop. Core inflation, which stripped out volatile food and energy prices, fell to 3.1%, the lowest since early 2021. That's particularly encouraging for the Federal Reserve, which watches core inflation closely when deciding whether to raise or lower interest rates. So, what's driving the slowdown? Economists pointed to several key factors. First, easing energy prices. Gasoline prices are down nearly 8% from a year ago thanks to, in part, of to steady oil production and softer global demand. Second, slower goods inflation. Supply chain disruption, that's a scale price in 2021 and 2022 have already largely eased, pushing down the cost of cars, appliances, and electronics. Third, moderating housing costs. While rents are still high in many cities, the pace of increases has slowed as more apartments come onto the market. Fourth, Federal Reserve rate hikes. The Fed's aggressive interest rate hikes over the past 2 years have cooled borrowing and spending, especially on big ticket items like homes and cars. Side by side images of gas pumps, groceries, assets, housing construction. The news was immediately welcomed on Wall Street. The Dow Jones jumped over 400 points after the report, while the S&P 500 hit a fresh 2025 high. Investors see the inflation slowdown as a sign that the Fed may be down raising rates and could even start cutting them next year if the trend continues. Chart showing Dow Jones and S&P 500 spike post report. A cooler inflation rate means businesses can plan with more certainty, potentially leading to stronger hiring and investment. For consumers, it could mean relief from steep prices increases and better access to credit. The Federal Reserve target inflation rate is 2%, and at 2.6% we are close, but not quite here. Fed Chair Jerome Powell has repeatedly said he wants to be sure inflation is truly under control before easing policy. Jerome Powell is speaking at a press conference. Some analysts believe the Fed could keep interest rates steady for the rest of 2025, while others predict one small rate cut before the year ends if inflation continues to decline. Lower rates would reduce borrowing costs for mortgage, car loans, and credit cards, but also risk reigniting inflation if the economy overheats. While the inflation slowdown is encouraging, many Americans still feel financial strain. Prices for essentials like groceries remain well above pre-pandemic levels. Even with lower inflation, it does not mean prices are falling, just that they are rising more slowly. interviews with shopper discussing prices in their area. For example, the cost of eggs is down from the last year's highs, but still about 30% higher than in 2019. Housing remains a major pressure point, with median rents still above $1,900 in most large cities. Economists warn that the fight against inflation is not over. Several factors could push prices up again. Rising global oil prices if geopolitical tensions escalate. Extreme weather events affecting crops and supply chains. A rebound in consumer spending if the job market remains strong and interest rates fall. Oil rigs flooded farmland, busy shopping malls. This risk means to the Fed will stay cautious, and why we are likely to see major rate cuts until they are convicted inflation is firmly back to 2%. So, what's the takeaway? Inflation cooling to 2.6% is a positive sign for the US economy. It means less pressure on the Federal Reserve, a friendlier environment for the stock market, and potentially some relief for consumer. But the road back to pre-pandemic price level is long, and the Fed is not ready to declare victory just yet. We will be watching closely as new data comes in over the next few months. Will the downward trend continue, or is this just a temporary dip? Time will tell. You have you have been watching Talkpoint. If you found this breakdown helpful, hit the notification button, subscribe, and turn on notifications so you don't miss our next deep dive into the stories shaping your money and your future. Thanks for watching, and we will see you in the next time.